when it comes to home equity lines of credit, though, you're looking at what's called an adjustable rate mortgage, right? So the
Ah,
rate, it might have a teaser rate, they call it, right? So it introduces this nice low rate, at 6% or 4%, depends on who you're working with, for, maybe the first 7 years, the first 5 years or 7 years. But then after that, after the teaser rate expires, then it begins to adjust, right? And every loan has a different adjustment period.
mm-hmm.
But let's go with a typical, 5-6 arm. So it'll be fixed for the first 5 years. After that 5 year period is over, then it begins adjusting over, the next 6 months. So every 6 months, it'll adjust based on the market rate, and the market rate will be typically nowadays it's based off of the SFOR index. Um, so it can fluctuate, right, during that 6 month period. There are caps that now exist to protect the borrower, so
Oh,
maybe
that's
they'll
kind
put
of
like
good.
there's going to be a periodic cap, and then there's going to be a lifetime cap as well. So periodically it might not be able to adjust more than 2%, above the original rate during that adjustment. But then during the lifetime cap, it might not ever go past 10%. So they have built in a lot of those, protections into arms. And that's typically how the HELOC works. A lot of the times, by the fifth year, when into that loan, most borrowers will refinance, but you never know what your situation is going to look like in
Right.
5 years from now. The
Mm-hmm.
life changes every minute of our day. So that's why I personally prefer a HE loan. It's more stable. It's predictable. You're not putting yourself in a vulnerable position in the later future. At the end of the
So,
day.